We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Today we're going to continue our strategy of Wyckoff trading with cause and effect. I recently did a video of the cause and effect trading example of the S&P 500 after the first drop. Now we're going to review that cause and effect, but we're going to look at the Dow and what to expect next. Now, quick highlight: a cause and effect is basically a consolidation pattern that meets the right standards for Wyckoff price and volume action. You accumulate, mark up, distribute, reaccumulate, and mark up, and a cause and effect that pattern. So this is a perfect one after just prior elections. A cause and effect accumulation based on the scare of slowdown in 2016. It was overdone. Big markup on Trump's tax cuts, and now we've got a massive cause, right? But the effect has technically failed. Now, why has the effect technically failed? Because it's retraced more than half of this previous pattern. Coming down to test it, should really have stopped here, and that's where the test should have stopped. Going a little bit deeper, like I think my alert is basically there, the dotted line. It should have stopped there, but it's gone down there. So what does that mean? So that basically means, let's go 1, 2, 3, 4, 5, 6 times Wall Street is loaded up on accumulation to go long, loaded up with leverage, and on the 6th time they're loaded up with leverage, believing the sky can never fall. All of a sudden, every gain they've made in the last 10 years can be wiped out. So they're caught. All the people have loaded up in here, believing the Fed's got their back, free money's going to save everything, printing money's going to save every economic issue. They get an event, let's call it a black swan event, which says printing money can't fix the situation. So they're loaded up with accumulation here, loaded up with debt, buybacks are ringing strong, they've gone a little bit long, and prices smashed them. So buybacks are dead, leverage is dead, massive people underwater. Okay? So that's a break in the cause and effect. This here is a true sign of weakness. Sign of strength, and this is a sign of strength up here. But quite frankly, as we knew between this gap here and that gap there, there was huge non-price signals. For example, there was warning in the spread between the 10-year and the German 10-year. There was warning in the NYSE margin. There was warning in the ISMs, and there was warning in the lack of volume taking this up. So I'm just sort of saying is that the biggest warning for me was how the NYSE margin did not confirm new high in stocks, and you'll see that on my blog. So what happens now? Everyone wants to know, what is Wall Street going to cook up now? What is the strategy? It's the same strategy that will happen now as that has happened many a time before. Now, believe it or not, there was a movie on the strategy, and it was called The Big Short. So at the moment, the status is big boys are loaded up, and they're loaded up with leverage, they're loaded up with debt, they're loaded up with options, and they've gone long, and within 2 weeks, they've smashed down. And there's no way the large positions built up here could have been exited out there, because otherwise it would be down at 15 or 12,000. Right? So now they've prayed for free money and stimulus from the central banks to stop the halt for all the typical reasons. But what happens now? Well, in the movie The Big Short, there's a video on it, and I refer you to The Big Short. You can see the title down there, you can Google it. Michael Burry, I think the name is, and a couple of other chaps said, right, we're going to go short the housing market when no one else was short it. They shorted the, I think it was the ABX index on US housing, and they loaded up to $500 million, Mr. Michael Burry did, I believe, and other people loaded up hundreds of millions of dollars. They went short early, and no one else was with them. As the market started to go from 4% down, retraced 4% to 5%, and it started to get down, the fundamentals came in, Bear Stearns, other banks started to roll over, and all of a sudden the major banks weren't pricing the ABX index lower, and actually they priced it higher. And this film here, this movie on the YouTube is about Michael Burry complaining the fact that the ABX index was not priced lower while the fundamentals were screaming, there's a crash going on. And he basically pointed out that that the big banks were actually keeping the index up fraudulently so they could go short as well, right? They held the index up, they held the printing so they could load up and going short. They weren't short, Wall Street was not short, so Goldman Sachs and all these big banks had to get a position to go short, otherwise they would not have enjoyed the move down. They had to go short to help avoid the calamity of actually losing more money. So watch that video, you'll understand how Wall Street missed out on a short. They held up the pricing of an index, they held it up, they got a bounce, and they allowed to go short themselves. So what's going to happen here? Just like 2007, let's go to 2007. Same chart, Dow Jones, monthly. Prices came off Bear Stearns, a bit of a smash down, and we got this move here that gave the chance for people to readjust their positions in Wall Street and go short. They were suffering some losses here, caught, right? This is around just after the holiday period. So everybody was on holiday when this was going on, that big bar. That was early January, no one back from holiday. They realised the crisis was pretty serious. They got a bit of a rally. They realised they're underwater, and they built up their big short positions here, and they basically rode the short positions down here to offset their losses in this area here. And I believe that's what's exactly happening now. So here we are. Cause, they're loaded up, they've got a huge amount of bad positions, underwater positions, with huge amount of leverage, margin calls collapsing everything, selling all the good assets. Now they're going to try and engineer a bounce above 22,000 or 21,000, maybe to 24 25,000, maybe over 2 or 3 months, and hopefully hold it up long enough so they can build some shorts up. Because now the question is, the the C19 virus is going to be defeated over the summer periods because of the warmer periods, and we should be okay after that. So they're sort of saying it's a 3 to 6 month thing, but quite frankly, that's pretty much unlikely. I'm not a doctor, but I'm betting that this is at least a 9 month a year thing. So we're going to get a bounce, allow us position adjustments. Hopefully they're going to try to suck in some of the public money. They're saying it's all okay, so you might get a vicious bounce up to 26. You may even get it up to 27,000. Things all right, but then we have to be very careful of the next test of 22,000. So as you can see, this is going to be an A, and we'll get a B. Wrong one. B around here, and a D. Sorry, a C. Maybe I'm choosing the wrong buttons here. Here we go. So where that C ends will be the question. Okay. So we've got this A now. This is the shock wave. This is the high volatility wave. Now we get a repair wave, and this construction of this wave, the news around this wave is going to be judged by all the experts. Is it going to be a recovery like 1987 and it continues up, or is it going to be a 1929 where it goes up and all the shorts have been loaded up so they can enjoy a downswing to recover their losses they've suffered here? Wall Street will be engineering their tactics now, just as they did in the Big Short movie with Michael Burry when they were wrong on the US housing. They held up the pricing of the ABX index, and they actually priced it higher when it should have been going lower, so they could organise the position themselves to limit their losses. The same game is ongoing now. So we'll have to wait and see. And obviously, if we consider the time frame, it's now it's now the middle of March. So we get March, April, May. A bit of a rally if we're lucky, a bit of a guessing here. So we get May, June, June and July and September are known to be the most dangerous months in stock market history. Not October. October is the volatility month. May, June, July, August. Let's say August as well. It can be very dangerous because that's when this type of thing can actually go wrong. So I don't know whether the bounce is going to be 2 weeks, 3 weeks, or 3 months. Okay. So I'm just sort of saying, think of the strategy. Think of what's going on. Think Think of all the positions in the portfolios that have been damaged, and these people are wondering, how do I secure less loss or even profit from this scenario? And I think the central banks would be saying, well, we can print 2 trillion, 3 trillion. The Fed will probably go to zero next week in the meetings because they fear that, because they'll be working for the banks to get their prices up. But at the end of the day, the big banks want the profit, and they've missed out on this short here. They've missed out on this short here. The big banks have missed out on this big move. They're underwater, they're hurting, they have to repair that. Either they've got to get a rally back up to here to recover their losses, but if that is not possible, even if it is possible, then they're going to get another downside test. It's just the way the markets work, and if there's profit to be made, it'll break lower. Okay, I'm going to restate, just like the Big Short movie, when the big banks were on the wrong side on the short of the housing, they have to manipulate the position so they can get in there and enjoy some of the profits. Thanks for watching. This is how the cause and effect trade can end and restart. Thanks for watching.